You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday here on the network. Time for a double dose of education. You already got your dose of OPR. It's already hit the network bright and early there today, so you get your dose of Mr. Overby there, a.k.a. the options guy. Now we're following up with Options Bootcamp. Don't tell Brian, but the premier educational options program out there. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding all of you, wherever you're getting this fine show, could be on our website, could be via our app, could be on Apple Podcasts, Podbean, Google, wherever the hell you get it. Make sure you keep rating and reviewing. It really does help folks continue to discover the content in these troubled times, particularly for a show like this. Particularly now, it is more important than ever. Keep rating and reviewing so new folks can come in. They can start at episode 1. They can start get their feet wet, get more comfortable with these options things so they can avoid some of the catastrophic errors that could really wipe out their portfolio. Of course, keep those questions and comments coming too. We do love to hear from all of you guys and gals out there. You continue to deluge us, and we love it. Keep it up. And let's see who we're going to hear from on the old show today. I'm pleased to be joined once again by my compatriot, my partner in all things Options Bootcamp drill instructor crime. He is the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, as well as the author of 1 or 2 or 6 or 12 options-oriented tomes. Mr. P, welcome back to the Options Bootcamp drill instructor proving ground, sir.
Fantastic to be here, Mark.
All right, let's do it. Let's get the ball rolling. A little bit of the old basic training.
Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out. Do you hear me? Yes, sir. Basic to complex. Yes, sir. There will be no failures. Do you hear me? Yes, sir. Pull in. Yes, sir. Prepare to learn. Yes, sir.
All right, everybody, welcome to the old basic training, the portion of the show where we break down some basic options concepts or technique or strategy and explain how you can use it in your own portfolio. We got a good one in store for you today. pretty much as basic as it gets, but also these days as fundamental as it gets. Before we get into that, Dan, I know you folks over there at MTM always watching the market, always watching volatility. Both those things very much in flux yet again coming into today's show. So what is lighting up your tape over there at MTM in terms of the market and volatility these days, sir?
Yeah, the market is rather interesting right now. We've got the S&P took a little bit of a little dipsy, but making a bit of a comeback as of today. And so volatility has become really, really cheap. Like I'm looking at the VIX level and it's 1942, which is, pretty low. But if you dig in and look at the actual volatility of, for example, calls you can sell for like covered calls, if you're doing that sort of thing on SPY, holy crap, they are cheap as can be. They've got a 12 handle. And boy, it's kind of the toughest time there is to be selling premium in some of these stocks. And don't get me wrong, there's definitely some where there's some overpriced premium. But I don't know. At this level, it seems like we always get a lot of resistance at par levels. In this case, 400 in SPY, 4,000 in SPX. And so I would expect bumping up on a little resistance. So because volatility is cheap, I've got some limit orders. They're probably not going to fill today. I got them GTC to buy some puts against my long-term holdings in my IRA for my spider positions. Just a little bit of a hedge, a partial hedge of the position, just going to scale into it. If I don't get them, that's okay. But if we start approaching 400, I'd sure love to own some cheap puts. I mean, why not, right?
It's hard to argue against hedging in this environment, sir. It's been pretty much almost exactly a year. I think it was a year ago yesterday where the V-shaped recovery really began in earnest. Here we are a year later. Who would have thought a year ago, if I had told you all the things that would have unfolded over the course of the past year, and then also added as a cherry on top, oh yeah, and by the way, all the major indices would be pretty much at or near or indeed through new all-time highs, up 40-odd% across the board. Dan, you probably would have said I was a crazy person, right? But yet here we are. So
I still say that, Mark.
Yes, you do say that off the air and indeed on the air sometimes as well. But who can fault you for looking at a little bit of hedging in this environment? If you're out there, listeners, if you're in that same boat, if you're long, shall we say the technical term, a boatload of equities, maybe you want to start thinking about hedging some of that up here. Again, do it in a diligent fashion, the way Dan was just talking about. We talked about many ways here on the show to get yourself some lower cost protection out there. Go back, check out the archives, check out those episodes, because it might be a time you might want to start thinking about that sort of thing. And speaking of things to think about, Dan, when we were talking about what to discuss on the show, an interesting thing popped up. You folks over there at MTM recently in your regular newsletter put out what you called a comprehensive guide on Delta for traders. Delta, of course, kind of the initial Greek, and the mother of the Greeks in many ways for a lot of the retail traders who are coming into options for the first time. They tend to fixate on Delta. It's kind of the one, for better or for worse, the one they really sink their teeth into a little bit. So I'm curious, Dan, why now? Why did you feel now that it was the time to revisit Delta and really go deep with a comprehensive guide into Delta, sir?
Man, Mark, I'll tell you, it's one of those things that like everybody needs a reminder of. And for folks who are new to our show, I mean, geez, if we have to start with one topic, I mean, Delta's sure in the top 10. I mean, of all the Greeks, Delta has the biggest impact on almost all your trades. And you sure get the most bang for your buck by starting there, learning about your Greeks. And if you're really experienced, you're going to use Delta on every single trade. You'll use the other Greeks too, but it sure is the most important one.
On one hand, the most straightforward of the Greeks, I think. On the other hand, it can be a little bit confusing because it's one of the few Greeks that really has multiple definitions. It means different things to different people, which usually adds a little bit of a layer of abstraction, a little bit of a layer of confusion to the listeners and certainly to the newcomers to the world of options. So let's break those down, Dan. Let's start with kind of the basic definition, the one that most people encounter when they first start learning about Delta, sir. How much the options price changes per rate of change in the underlying, sir?
Yeah. So, well, I mean, you mind if I back up and kind of go big picture here a little bit, Mark?
Go crazy.
Short trip for me, but yeah. So, I mean, I would say that there's 4 definitions of delta, and one is that textbook definition. It's how much an option or option position, so it could be a spread or whatever, moves relative to the underlying. And we like to think about that always as, hey, if the stock goes up $1, the call increases by the amount of the delta, or the put decreases by the amount of the delta. But, like it's really a percentage. I mean, if the stock moves 43 cents, we just multiply that times, the delta in decimal terms. So that's definition 1. Another is it's basically the derivative of the price of the option price relative to the stock price, which basically just restates what we just said before. The third rather, is that it is the equivalence of the number of shares that you would effectively own to have that same directional sensitivity. So like if I have a position that has positive 230 delta, which would be 2.3 delta, depending on where your broker puts a decimal point, that's like being long 230 shares effectively. You have that same directional sensitivity. And of course, the fourth is a little bit more controversial, I guess, in that it's not 100% mathematically correct, but it's an estimate of the likelihood of that option expiring in the money.
Yes, the many definitions of delta. You're right. When you and I were on the floor, the hedge ratio, as we used to call it, was kind of the primary definition of delta that we used to fixate on for our purposes, because we weren't there really to take a lot of directional risk. We used to trade in a style that's called delta neutral. We wanted to wipe out the delta risk and focus on things like theta and vega and all the other Greeks out there. So we would come in, look at how many shares of the equivalent underlying we would get from buying or selling whatever position we were trading at the time. Then we would turn around and typically sell that many shares against it to wipe out that delta risk. So that's why the hedge ratio was the most important one for us. But for a lot of newcomers coming in to the options market, that option sensitivity to movements in the underlying is kind of the bang for the buck. It's kind of really what you're paying for when you're buying options and what you have to watch out for when you're selling options. But I'm also glad you mentioned that fourth definition, Dan, because you're right. That is a bit of a contentious one, I think, to say the least out there. It's funny because it became secondhand. It almost became the vernacular of trading. When you'd walk around on the floor of the SIBO or somewhere else, even still to this day, when I see people who are old school former SIBO traders and you say, are you going to do something? You're going to be there. They always say, well, I'm like a 70 delta. It's become just a shorthand for the probability of doing something. So it's just become ingrained in the culture, ingrained in the lingo. But as you say, it's not entirely correct. So I'm curious for you, where do you fall on this contentious issue, sir? When people come to you and say, hey, Dan, what's the deal with delta being the probability of an option expiring in the money? Where do you fall on this, sir?
Mark, I always tell them, look, it's a nice loose rule of thumb that every trader I ever met uses, but just understand that it is a loose rule of thumb and you have to take it with a grain of salt and just understand that it has limitations.
Yeah, so if you go out there, you buy an option has a 63 delta listen. It doesn't mean you have an exactly 63% probability of your option expiring in the money. Now, it's a good ballpark. It's a good kind of a guidepost, a rule of thumb. If you're looking at it, you can say, yeah, maybe you have somewhere in that range of probability, but it's going to vary depending on the volatility in the market. There are a number of other factors that weigh into what the actual probability of your option expiring in the money are. So bear that in mind. Delta, you're going to have people using it in that case all the time, using it effectively interchangeably with the probability, and know that it is not. It is just a ballpark estimate of what you can expect, but usually decently accurate ballpark estimate. Now, Dan, I know in your deep dive over there to your clients, you kind of went through some of the benefits and a quick example. You want to hit us with those, sir?
Oh, yeah. I mean, there's a million examples, and because, you can pretty much use it. Oh, man, it's so versatile. It's used for getting into a trade, for analyzing the trade, for getting out of the trade, setting expectations. Geez. So like one of the things, I mean, here's just a really simple one. Since we were talking about covered calls and spiders, like a lot of people don't think about using delta based on covered calls. Like, it just kind of seems weird, but it sure helps manage expectations, because a lot of times people trade a covered call and the stock goes up and they're like, oh man, I lost money on the call, and they get really hung up on that. And they see they made money and they're like, oh, I didn't make as much as I should have. But if you just simply look at the delta of the, long 100 deltas for the stock, short, 27 delta or whatever it is on the call, that position would have, a 73 delta. And that gives you some good expectations as to what you would expect to make if it moves a certain amount today. Other stuff is just simply buying a call, right? If I buy a call in, say, who knows what, Airbnb, right? I want to buy some out of the money calls. It has a 35 delta. If Airbnb goes up $3 today, I know that I'm going to make, based on delta anyway, about, what does that come out to? $1.05, right? 35 delta times $3. If that move, and then of course we want to factor in the other Greeks. If that happens over a few days, we factor in theta. If implied volatility change, we factor in vega. But like, it is just so darn useful. Like, I couldn't possibly trade without using that information.
Now, one of the things I've always said, and it's a bit of a gross generalization, but it tends to be true. I'm curious what your thoughts on it are, Dan, is that effectively when people come into the options market for the first time, particularly the audience for this show, your basic retail stock trader, they're typically coming from the stock world. And so when they look at options, they tend to fixate around delta. That's kind of their entry point. That's really what they're coming to the options market for. They're using options as a surrogate for the underlying. So they're really looking to just get that underlying movement, or perhaps not get it if they're selling the options out there. Whereas the professional traders and more experienced tend to focus on the Greeks like vega and also theta and things like that. Dan, do you think that gross generalization, as I term it, you think that still applies out there for the retail versus the professional masses, sir? Or do you take deep umbrage with that?
No, 100%. Like, in position management and even in portfolio management, like, people look at options, they're like, oh yeah, I'm a 5-lot trader. I always trade 5 lots in options. But I mean, a 5-lot is a huge difference if we're talking about an 80 delta option or a 10 delta option. And then of course, if we want to get more complicated, we could factor in, dollar deltas too, but maybe that's a discussion for a different show. So yeah, I mean, so important. Like, if you're sitting there and you're like, you buy these calls or this bull call spread, and you buy a certain number and you're like, man, I'm really not making as much as I thought, or holy cow, I lost a whole bunch more than I thought. This is weird. Look at your delta. Like, that's why.
So there you go, listeners. It's, in one hand, the most basic, the most introductory of options concepts, which is delta. On the other hand, it's sometimes misunderstood, certainly with the many different definitions of delta floating around out there, some used incorrectly. It could certainly lead to some misperceptions out there. And certainly for a lot of you in the audience for this program coming to options for the first time, or you're still pretty new to the options game, delta is kind of your gatekeeper. Delta is kind of the big dog. It's kind of what you're fixating on. Everyone out there slinging calls on the Teslas and the games and the AMCs and everything else out there, you're all looking pretty much to get a big delta boom in the underlying, right? Big swing for the fences with the stock. And so just bear in mind, there are, of course, other Greeks. We've gotten into them many times here on the show. Check out the archives. Check out Dan's book, Trading Options Greeks, as well, for a deep dive into. But it seemed like a good time to do a bit of a deep dive, bit of a refresher, and maybe clarify some of the misperceptions around delta. But you know what? You folks have your own questions and indeed your own misperceptions. So let's get to those. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's do it. Let's dive on in to your mail call let's kick this off with a question from, let's see, is there a question burning a hole in the pocket of the MTM community? Mr. P, do you have a burning MTM question of the week, sir?
I do, Mark. And, I got a few questions this week. And honestly, I'm trying to remember which one I did last week because, they kind of run back to back. But the one that I got had to do with vertical skew. And if this is the one I talked about last week, I'm actually going to expand upon it anyway. So what is vertical skew? Well, first of all, let me talk about what normal vertical skew is. And so if we look at a typical stock or ETF, Spiders, Johnson & Johnson, a lot of your just typical run-of-the-mill stocks, and I would say this is true for about 90% of them, the lower strikes tend to have higher implied volatility. They tend to be, in relative terms, more expensive. And so the reason for that is because people tend to buy puts, just like I was talking about earlier, they buy puts for protection. Those tend to have lower strikes, and the in-the-money calls that have those corresponding strikes are synthetically equivalent, so it doesn't matter if we're talking calls or puts. The higher strikes, people tend to sell out-of-the-money covered calls to generate income, which are synthetically equivalent to the corresponding strikes for the in-the-money puts, so it doesn't matter if we're talking calls or puts. Either way, normal vertical skew, the lower the strike, the higher the volatility, the higher the strike, the lower the volatility. But sometimes, and there are some really, really interesting cases, I was actually just putting together a video on this this morning, is where we see a different paradigm. One is in Rocket, RKT. If you're listening to this live, March 24th, 2021, we see an inverted skew where the lower strikes have lower vol and the higher strikes have higher vol. And that seems really, really weird. But when you start thinking about it, why is that? It's because that's where the demand is. It's in the upside calls because that's one of those meme stocks. People are expecting a big pop. And instead of paying, $23 a share, they'd rather pay $1.50 a share, even if they're overpaying for it. Another one is ASO, which if you're listening to this live today, that has what we call a volatility smile, which is really strange. The at the monies have the lowest implied volatility, and the lower strikes and the higher strikes have a higher volatility because it's a meme stock. People are expecting a pop, but there's a lot of short interest and people are afraid that it could fall. So they're buying those wings, as we like to put it. Really fascinating stuff, and not just intellectually fascinating, but has super great utility for trading.
That it does, sir. Let's keep on rolling here. Question from Nico. Nico says, fascinating discussion about mini options. He's, of course, referring to our deep dive on all things mini and fractional on our last episode. He says, just wondering, has there been any news on this front? I think he means anyone. Has anyone officially announced that they are coming back? Well, no, Nico, not that I have seen of yet. I haven't seen any releases from anywhere. And of course, this would have to come, if you're going to release the minis, it would have to come from the exchanges and from OCC, because they're the ones that are going to have to list these things, and OCC is going to have to clear them. And we haven't seen anything along that front yet. What kind of prompted that was just the relative level of price appreciation we've seen in many of the names you folks are trading out there now, which makes them ripe for a mini. When they're getting north of $1,000+, minis start to come into the conversation. And also the conversation we had with some of the brokerage folks recently about the possibility of fractional options. All that kind of raised the specter of a mini. And also let's looking at what's going on in places like CME, where they have not just minis, but micros, and they're just blowing the doors off them with volume in those things. So it seems like everything small is big again. If ever there was a time that was ripe for the reintroduction of mini options, it would be now. Yet officially, Nico, there has been no word yet on this front, but I'm digging around behind the scenes. I'll see if I can find something for you and for the rest of the folks out there. Don't worry, we are on the case, Mr. Nico. All right, next up, we got a question from the live chat. Dan, Mr. Unlimited, he wants to know, how come deltas with 80 plus cents, I think it just means 80 plus deltas, don't have as much volume? Is it because they don't have much more room to move because 100 is the most? So you're talking 80 plus delta options, Mr. Unlimited and everybody else out there. These are pretty in the money options. Remember your ballparks there, and your at the money option is going to typically have a delta right around 50. So you know if an option's delta is above 50, it's going to be an in the money option. It's kind of one of your standard ballpark frames of reference when looking at an options chain. So an 80 plus delta option is going to be pretty substantially in the money. And what tends to happen when things get in the money like that, Mr. Unlimited, is a couple of things. First off, they get to be a little bit more expensive now. Because remember, you don't just have the extrinsic value, the premium. You now have that intrinsic value. So anyone who's got to trade those things is going to have to trade a much meatier, more expensive option. So as a result, the volume tends to drop off on those strikes. And also, as they get bigger, more expensive, they get closer to actually the underlying stock itself in terms of a delta perspective. You're going to see that spread start to widen out, the bid-ask spread in those names as well. Yet another reason why the options volume tends to dry up in those strikes there. When you look at most options chains, that's going to be somewhere in the strong majority. Let's say 75%. How about that? Is going to be in the out of the money portions of that options chain. So the out of the money calls, aka less than 50 delta calls, and the out of the money puts, aka the less than 50 delta puts. And so that's typically the case in most of the names you folks are going to trade out there, the equities, the big indexes, and things like that. It could change in other, talking commodities and other products that have different types of skews and volatility. But for the most of the names you folks are trading out there, that's where the lion's share of the volume is. That's why in some of the products that are more expensive, a little bit less volume, that's why the spreads tend to widen out. Mr. P, anything to add here on why the meatier delta options don't have as much volume, sir?
You covered a lot of it. I just want to kind of highlight some of the stuff that you said, just because I agree 100%. I think it's really important. And just high level, why don't they have more volume? By definition, because fewer people trade them, right? And fewer people trade them for a couple reasons that are really important that Mark said. One is in the money options have a wider bid-ask spread. Like they're just not as good. Like you have to make up more of that bid-ask spread just to break even. It's harder to make money with them, and they have more risk if you're wrong. And so, I think you'll find as you progress through your education with options and your experience and your expertise that you'll use in the money options less and less. I feel like in the money options are mostly kind of a starter position, right? Like people who are used to buying stock, they say, oh, well, I can buy this in the money call instead, and it's cheaper and it moves a whole lot like the stock. It's kind of like your introduction to options trading, but the more you learn and the more you see the power of everything you can do with spreads and, out of the monies and using the Greeks, the more you'll move away from those in the money options, I think.
Yeah, typically, unless you're doing one of the strategies we talked about before, like the stock replacement type strategies, or as Brian calls them on his Playbook Radio show, the fig leaf type strategies. But just bear in mind, we said it before with those strategies, this exact problem. Once you start trading those deeper in the money options, or once a position you have that's out of the money goes in the money, those spreads are going to widen out. So you have to do a little bit more homework, be a little bit more aggressive, work them a little bit more aggressively in order to get out of them without getting hurt on the bid-ask spread. All right, Dan, next up we got a question from Ben C. He's got the old saw of credit versus debit spreads here. Ben says, great to hear you answer my last question. We've created a monster, Dan. He says, now I have more. Give him one. They send in 100 more. All right. Hey, we love all of our listeners out there in all various capacities. His first question, I'll be nice. Usually I limit you to one, but I'll be nice. I'll give you two here. He says, first, debit spreads seem like a bad deal compared to credit spreads. To get the same risk-reward profile, a debit spread requires the underlying price to move, where a credit spread does not. Why would I ever do a debit spread when I can do the synthetically equivalent credit spread and have a higher probability of success? And then the second part of his question, he says, every time I look at doing a time spread, the further out option has too high of a bid-ask spread to be reasonable. Are these only viable in super liquid names? I'll tell you what, Ben C., I'll start with your second part of your question first, because it's kind of analogous to what we were just talking about. We were just talking about deep in the money options and how the spreads start to get a little bit wider and the volume starts to dry up. Well, guess what also happens when you go farther out the options chain in terms of expiration? The exact same thing tends to happen. You start to see spreads widen out a little bit and you start to see volume dry up. Outside of the most liquid names, your Apples and things like that, those hold their little bit more liquidity over time. But even still, once you get away from front month at the money in a name like Apple and go out a month or two, that liquidity starts to fall off a cliff too. So the lion's share of the liquidity to be found in the options market is not just found in a handful of names, but really in a handful of months and strikes in those handful of names. That's where most of the business is done. And now as you're discovering here with your calendar spreads or as your time spreads, as you go a little bit farther out, that longer term leg is challenging because, like we just said, bid-ask spreads are wide, volume is light. There's a reason why the majority of the calendars that go up, and certainly the ones we hear from on our audience and what people are doing out there, are typically 1 month. They go out 1 month and they buy the 1 month typically at the money contract because A, it's easier to understand for most people, and B, that's where the liquidity is. And then they turn around and sell that front month at the money contract, again, for the same reason. And so that's the lion's share of the time spreads and calendar spreads that you're seeing is a simple 1 month calendar at the money. Once you start getting beyond that, getting funkier, go out more months, the issue you just encountered it starts to rear its ugly head. So unfortunately, if you want to start doing funky calendars, you kind of have to keep it to the liquid names. Otherwise, you have to be super diligent on really trying to work it. And then good luck getting executed at anything close to a midpoint, unless it's a very liquid name. The market makers don't have too much incentive to step up and affiliate. Dan, anything to add on the second part of his question? And then feel free to tackle the first part, which is one of the old saws of the option space, sir, the debit versus credit spread.
Yeah, just to add maybe a little bit to the second part. I typically observe exactly what Mark's saying too. One thing is, two things. One is, whatever you're trading, you always want to trade something with tight bid asks because that slippage, that's your biggest cost in a trade, way bigger than your commissions. But also, I tend to find that a lot of times, not always, but a lot of times, the options that have monthlies and weeklies, the monthlies tend to have tighter bid ask spreads when you go further out. If you're selling the ones that expire today, but then, the next week as a choice to buy as a weekly, the next week to further out, that's a choice to buy as a weekly, and the next week yet further out as a choice to buy as a monthly, that monthly probably has tighter bid-ask spreads. So, just look around at different choices as to which expiration to buy. As far as the first part of this question, I would argue, and this is definitely factual, but in practice, there's something to it. So bear with me on this. I would argue that debit spreads and credit spreads are the same thing. They're synthetically equivalent. And so it kind of doesn't matter which one you trade. Now, that being said, in practice, what we typically do is when we're selling credit spreads is we sell out of the monies, and the short strike is a strike we think the stock cannot reach. Whereas when we buy debit spreads, we're probably buying an at the money or maybe one option in the money or both options out of the money. And so with the credit spreads, low volatility is good. It's volatility selling. If it goes your way delta-wise, great. If it doesn't move at all, great. If it moves a little bit against you, great. Odds are on your side, but your risk reward is consequently disproportionate. With debit spreads, it has to move, so your chances of winning on a debit spread are smaller to varying degrees depending on how you construct it relative to a credit spread, but your risk reward tends to be a little better. So, I would definitely say that neither are better than the other. I would say debit spreads are not necessarily a bad deal. It's just a different style of trade. You definitely have a better chance of winning, but your risk reward isn't as good. And that's just natural. I always like to go with the extreme examples of if you could bet $1 and win $100 million, would you do it? Sounds like a great deal. Well, that's called the lottery. Like, are you going to dump all your money into lottery tickets? Maybe not, because your chances of winning aren't as good. That's just one sort of extreme example that relates to this conversation. There's always this trade-off between chance of success versus risk reward.
Something might be a good topic for a future show, sir. What do you think, Dan? Should we wade even further on an upcoming show into the great credit versus debit spread debate, sir?
Oh, man, I'd love that. I've got a lot to say about this topic. That sounds fun.
We would create even more of a monster for Ben. Not only does he get his questions answered, he's created a topic for a whole new show. But well done there to all of our listeners with your keen, insightful questions. Keep them coming. Even if you don't have time to get to all of them. We try to squeeze in as many mail call segments as we can. Listen, we can go for many hours. Unfortunately, we have other stuff to crank away today here on the network. So we have to bring this one to a close here today. But before we go, Mr. Dan, if folks are intrigued, maybe they want to check out the newsletter, of which you did a deep dive into Delta that we talked about at the top of the show. Maybe they want to get their questions featured in the MTM question of the week. Where should they go? What should they do?
Yeah, if you make your way over to markettaker.com, so market like stock market, taker like take what is rightfully yours, 2 T's in a row, markettaker.com. If you just sign up for a free account there, you can join free. That'll automatically put you on our weekly free newsletter list. And, it's really great. It's not like we're emailing you 5 times a day or something like that. You get this email once a week, and there's a really useful article. And I think anybody listening to the show is trying to kind of bone up and get a better understanding of options. So I think you'll really love it. It doesn't cost you a dime. Just go to markettaker.com, join free, and you get that, and plus a whole bunch of free classes too. It's great.
There you go. Check it out, markettaker.com, 2 T's. And if you want to check out some interesting investing opportunities outside of just, you like these options things, you want to go even deeper, maybe into the infrastructure, maybe into the bowels of the volatility market, well, then Demand Derivatives, 2 D's, DEMAND derivatives.com is the place to go. Click on their equity crowdfunding portal. Low minimums, right around $100, 105, 115, something like that. And you can get a piece of the action. I know everyone's out there pouring money into these hot fintech startups out there, all the Robinhood wannabes and everything else out there. Get a piece of an exchange in the volatility space. How often can you say that? DemandDerivatives.com is the place to go. And on behalf of Mr. P and our friends over there at Demand Derivatives, and indeed myself, thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. You folks are the guideposts for this show, really. You send in great questions. You lead to interesting conversations that lead to further episodes. So if you guys like the idea of the debit versus credit spread battle palooza coming up on the show, hit us up. Let us know what you think. Also, if you have related questions about debits and credit spreads, hit us up. We'll make sure to work them into the show. We'll be back again later. I mean, you just got OPR, so you already have OPR waiting for you. If you're listening live, go grab your device wherever you listen to our podcast. Brian's up there already with Options Playbook Radio. We'll, of course, be back again tomorrow for your double dose of content. You've got TWIFO coming at you tomorrow, as well as episode 2 of the Option Block Friday. Volatility views. It all kicks off again on Monday with the Option Block and Crypto Rundown. Interview Tuesday. And then back again with another Education Wednesday. Another episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.